All attendees are in listen-only mode.
Good morning, everyone. This is Mark Raymakers here with Insurance Agency Marketing Services, along with Kip Walker from Mutual Trust Life. He's going to be the one who's going to provide you the meat of the webinar this morning on the IBC concept. You've heard it named many different things, and I'm sure Kip will probably explain to you so that for those of you who've heard it before, there are a number of different topics, or not topics, but the ways that we refer to it as. Some of these are trademarks. We have to be pretty careful in what we say and how we say it. So with that said, this is a recorded webinar. So once we get done this morning, I'll shoot that over to you. You have a chance to review it. If you have any questions, you can certainly type those in the question box. And this is the first one of a couple different presentations we're going to be doing on this particular concept. So you'll be receiving another invitation here for the next event, which is 2 weeks from today, I believe. So, all right, so real quick here, I'm going to go through a few things that we do here for our advisors with Insurance Agency Marketing Services. And so if you want to just kind of sit tight here, for those of you that are brand new to our webinars, I do see some new names here. I'll get a chance to tell you real quick what we do and how we can help you in your business. Obviously, there's a lot of competition out there. And so I think we set ourselves apart with the things we're going to go through here real quick. First off, the new producer bonus. So anyone who's brand new to us, what we do is we provide you a bonus for your production. This is obviously a way to get you to contract, to get you up and running here and kind of get in the groove and see how we do things. And once you take off on that path right away, for those of you I see that are contracted with us, I'm sure you can attest to the fact that we do a nice job of supporting you. So first thing is, we're talking different levels based on premiums. So whether you're talking single premium life, annuities, or dollar for dollar, but if you look at like traditional life, it's a fraction of that. So it's not 100,000 in target life. But let's just say, for example, you look at the 100,000 level. You can choose at this point to cash in, get a $750 cash bonus, or a 2-year subscription to the website newsletter service. Now, Josh in our office can help you with that if you wanted to just buy into a program. It's very affordable if you don't have a website now, but he can have that up and running for you in 1 business day. Or you might opt to go ahead and get the iPad. I know a lot of companies are moving towards the e-app, so this is nice. You don't have to worry about messing up an application, leaving something blank, or maybe missing a form. This is a great way to help you be very effective and efficient in the application process. You might wait till the 300,000 level where you could do one of each, one of these 3 here. Now, the first 2 are ones you can not only earn, but you could buy those. So if you didn't want to wait till you earned it, you can certainly buy in. And the first is a full Social Security program, the 3,000-piece postcard mailing. This is a great way to get in front of more senior potential buyers. Now, obviously, you're not making any money by giving them advice on Social Security, but it's going through their portfolio, make sure everything is up to date, positioned correctly. So this is a very effective, very successful program. You might want to go ahead and take advantage of the $2,000 in matching marketing money to promote your business. And this one here, however you want to use it, that's great. Or there's a $1,500 gift card. Now, the next level, as I mentioned, these are ones that you can buy into. So if you opted not to, earn those, you could purchase these, and you can call and ask for anyone in annuity marketing. They can discuss these with you. But these 2, the first is the 5,000-piece mailing and seminar coaching with Matt Gill, or the 4,000-piece mailing and seminar coaching with Dave Pimper. These 2 gentlemen are very, very effective in their seminar selling. So maybe you've done it in the past, haven't been successful, or maybe you're considering doing it in the future. This is an opportunity for you to really get a great program that works very effectively. So those are either an earn or buy, but that's at the 500,000 level. A lot of you might say, hey, I got a great program now. I just want to take a break. I want to get away for a while. You can take advantage of the Ritz-Carlton Travel Rewards, make your own personal getaway. Speaking of getting away, we have our top producers escapes. We basically have a qualification for a trip. Generally, you're talking about an 18-month qualification. And so what we have coming up here is our Boulders Resort and Spa in Scottsdale, Arizona. That'll be February 25th, 28th next year. And you see down here at the bottom of the screen, we're going to base that on a combination of production from every product that we offer. That product line could be crossed over. So if you're doing annuities, you write life insurance, anything you do, again, will qualify or go towards the qualification for you and a guest. And that period started July 1st of last year, goes till December 31st of this year. And with the Department of Labor ruling, that'll have to be kind of reword a little bit differently as you, for those of you that are following it. There's a different way of, I guess, qualifying for trips. But you'll notice with a lot of life insurance companies today, it's a little bit different than when you're looking at annuities. So anyhow, let's move on. Creative services. This is something that I'm really excited about. A couple different reasons. There's so many things out there right now that agents are not taking advantage of as far as social media or just branding themselves, setting up a website, doing any kind of real advertising. Our creative services department here can help you with everything that you see on here, anywhere from just creating a logo for yourself all the way up to television advertisements. So if you want to know more about that, just call and ask for Josh, and he can go ahead and explain what we can do to help here. So you know what? It looks like there we go. Okay, I'm sorry. I didn't realize that you weren't able to see my screen. So all right, so we're good. Okay, so something else here, you know, that Josh can help you with is the social marketing side. So I know a lot of our advisors are taking advantage of Facebook. And so if you wanted to do more of that or do emails to your clients, we've got some great tools out there that can help you. And so keep in mind, Josh in our office here can help you with that. So be sure to give him a call and ask him about that as well if you want to take advantage of some of the social marketing that's out there. Okay, I've got a couple polls real quick, and I know the quicker we do this, the quicker we can get into what Kip has to cover with us today. But one of the things that we do here, and you'll notice that we are real big on education. That's why we have webinars every day of the week, pretty much, Monday through Friday. And so what we do here is we have an all-expense-paid life and annuity training academy. And we've got one coming up here. We do generally 3 of those a year. We've got one coming up in September and then another one in early November. So the one that we have in September is it's a Wednesday, Thursday, Friday. I believe it is the first week in September. So here's what we do. We bring speakers in from across the country to talk about a number of different sales ideas and topics and concepts. And this is not a product training. So what we do is we fly you in on a Wednesday. We get you there for Wednesday evening. We do heavy hors d'oeuvres or dinner with a few short presentations. Then on Thursday, we hit it hard, a full day of training. And then on Friday, we'll get back together again in the morning. We wrap it up on Friday at noon, and then we send you back home. So IMS pays for your airfare, your meals, and your lodging. So really, there's no out-of-pocket expense for you at all. Now, if you're interested in knowing more about this, whether that be just getting an agenda or if you want to know the exact dates, if you're interested in this at all, mark yes. Then what we'll do is we'll email you the agenda. We'll let you know when the dates are so that you have that. You can check your calendar. And we're generally going to take up to about 40 people, depending on which event we're doing. So the nice thing about this is that it gives you an opportunity to learn more about whether it be seminar selling. I mentioned that Matt and Dave, they do their seminar presentation. They'll actually be there for that. We have a presentation like the one we're going to talk about here this morning. It's in greater detail. So if you're looking at maybe growing your business or maybe incorporating more into your business, utilizing some of the different new trending concepts and things like that out there, then this is definitely worth it. And if you're not getting free training today, why not take advantage of this? I can tell you, I've been here for 8 years, and we've been doing these as long as I've been here, and I've never heard an agent say this was a waste of my time. I've actually had agents that have been going out to these different training events, have been to dozens of them, and said they have never attended a better event than this. So I was in the field myself, and I can tell you that what we're going through in these different events will help you to grow your business. So I'm going to go ahead and wrap this up. I'm going to close this poll. So if you decide that you want to know more about it, you want an application, you want to apply, you want to see the agenda, you can certainly call and ask for anyone in the marketing department, and they can get this over to you. So we're going to close it up here. It looks like a couple more of you have voted in here. So just mark yes if you're interested, and we'll move on. Okay, I'm closing it out. Let's move on here. Okay, so something that we can do for you if you want to get contracted with this is very simple. You can call and ask for anyone in marketing. They'll email you a contract, and what you do is you complete this document one time, give us a copy of your E&O, copy of your license, etc. Then what we do is we hold that in a database so that if you ever want to add other carriers with us, All you have to do is talk to anyone in marketing that you're working with and saying, hey, I want to have this carrier. That's it. There's no more paper for you to complete. It's very simple. And then if you want, you can go directly to our website to get that. It's www.imzing.com. And you'll notice here there's a lot of different things out there that are going to help you with your business. It could be anything from forms to quoters, you name it, it is out there for you. And so I'd encourage you to check that out. It's www.imzing.com. So here's something I'm really excited about as well. We started our own RIA, and with the Department of Labor ruling that came out, we've created the IMS Wealth Management Department. And so, or company. So what I would do is I would encourage you, if you're not series licensed, if you have questions about the DOL, if you want to do more for your clients, this is a great way for you to increase your revenue through managing of money, through offering a full line of products and services to your clients. And we're going to actually help you to, as far as taking that Series 65 exam, we're going to help you with that. Now, I do know when I was in the field, I had my series exam as well. And the nice thing about this is that your clients can come to you pretty much for everything. And it really helps the retention. The more lines of coverage that you have, the more benefits you can provide to your clients, the more likely you are to keep them. And so just real quick here, I'm going to put out one last poll here. So if you would just mark yes or no if you want, I can have one of our gentlemen from the IMS Wealth Management give you a call here, and then they can discuss. If you have any questions about the DOL, I know there's a lot of unanswered questions out there. If you want to know what we can to help you, I will tell you right now that one of the things that comes up a lot is commissions. Our grid right now is top of the line. So if you're concerned about maybe you're not getting paid very well through your current arrangement, this is an opportunity for you to kick the tires. Check it out. See what we can do for you. You could run all of your business through one shop here. It makes it very easy for you. And for those of you that maybe want to call in, again, the number for them is 888-255-7670. Okay, great response here. I'm going to go ahead and close this, and I'm going to move on here. I am just about done with my part, Kip. My goodness, we still have folks that are marking yes here. So, okay, again, if you want someone from the IMS Wealth Management to call you, just go ahead and type in IMS Wealth, and then we'll have someone call you, or just call the number. Okay, so retirement analysts are a great way for you to take a holistic approach of planning, and this would tie in very nicely with the IMS Wealth Management team. So if you haven't seen the Retirement Analyzer, it's a great way for you to get a full perspective of your clients' finances. And you'll see here some of the graphs. Now, this is going to tell you whether or not your clients are able to retire when they want to and at the income level that they want to as well. And this is really designed for people that are computer savvy. If you're not real good with the computer, if you can't figure out how to turn them on or turn them off, this isn't for you. But I would certainly encourage you, if you want to take a look at a good program, go ahead and ask for anyone in the annuity department. This is my last slide, and I'll turn this over to Kip. So one thing that I want to tell you about is a referred producer program. This is pretty neat. In fact, I just got done signing off on a check for an agent for referral. And this is for just under $400 just in the last quarter from referral that he sent to us. This guy's doing some pretty good business with us. So basically, here's what happens is when you refer somebody to us, what we do is when we get them contracted, we will send you a check for $50 just for contracting that individual. And then in addition to that, every time they write a piece of business, for example, let's say they're doing a annuity or single premium life or traditional life, but on the SPL and the annuities is 20 basis points, a little bit different when you're looking at target life premium. So what happens is what we do every quarter is we send a check out for that agent's production. And as I mentioned, I just signed off on one here this morning. It was around $400 for a referral. And so this is something you get every quarter as long as your referral is producing. It doesn't matter. I have signed off on checks where we're talking $10,000 over a year's period. So if you think of somebody that might be a good referral, you can call us, call me, and I'll get their name and I will get their number from you and I will work to get them contracted. And every time they write business, you're going to get paid for it. Now, you're not in the commission business, so don't worry about that. Neither are they. There's no haircuts, nothing. It's just our way of saying thanks for the business. One last thing. There's a lot of agents that do not take advantage of this, and they're with us today. But we have a marketing reimbursement program. So let's say you decide that you want to go into seminars. You're going to start doing that. Or maybe you need a new postage machine, or gosh, I don't know, maybe you need, we've got an agent who's remodeled his office based on his marketing reimbursement. And so all you do is you send us a receipt. We turn around and we send you a check for 50% of whatever that expense is. So now you figure you're cutting your expenses in half to market, which obviously puts more money back in your pocket. So remember that if when you get contract with us here with Mutual Trust Life, you start writing business, we're going to reimburse you for your expenses. So, okay. I'm going to go ahead and I'm going to turn this over to you, Kip. So if you've got your screen up, I'm going to give you full control here. Can you hear me, Kip?
I can, yeah. I'm just getting my slideshow set up here. Sorry, Mark. There we go. Okay, thanks everybody for joining us today, and thanks, Mark, for hosting this call again. We've done this several times now, and it's always great to be back with IMS, and it's an organization that offers so much, and we have another concept that we'd like to share with you that really deals with the issue of our clients saving for their retirement without the aids of pension, and Social Security may not be what they hope it's going to be in the future. So they're facing a very low interest rate environment. The infinite banking concept, it goes a long way in helping them achieve their financial goals and make everything that they're doing already work better. So as we go through this presentation, I would ask that you take notes. Think of clients that you're already working with in your calendar, in your book of business, on your desk, and everything I'm going to show you is going to look good because obviously we make sure that it does. But I can't make anybody an expert in anything in the next 20 or 30 minutes. And if we can't make this work for you, then, what are we doing here? So write down those names, and that will be our basis for making this a success. Quick look at our agenda here. Introduce the concept to you, the history, what our client looks like, and then how Mutual Trust supports the infinite banking concept. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it. That is a great quote by Robert Kiyosaki. He was the author of the Rich Dad, Poor Dad books. And this really encapsulates what the infinite banking concept is all about. How do we help to grow our wealth, accumulate more wealth, and have it last for generations, and make it work for us more efficiently, make our money work for us more efficiently. This isn't a brand new concept. J.C. Penney used it to help meet payroll during the Great Depression. Walt Disney used it to start Disneyland. He had, he was not able to get more capital to do any other expansion. He wanted to start Disneyland, and he had no access to capital to do it. He was tapped out. And so I think he was in business with his brother at that time, and the brother wasn't so keen on the idea of Disneyland. So Walt Disney took a loan against his policy, his life insurance policy, started Disneyland. Ray Kroc used it to start McDonald's, and Doris Christopher used it to start Pampered Chef out of her garage. So this isn't a brand new concept. It's been around for a while. And a gentleman by the name of Nelson Nash actually gave it a name and popularized it in his book in 2000 called Becoming Your Own Banker. We've been working with Nelson pretty close to the beginning, and great guy. He has they have a Becoming Your Own Banker Institute, and you can become certified in the infinite banking concept. However, you don't have to become certified to put this concept into practice. This is a concept that Mutual Trust supports free of charge, and you can actually earn expense reimbursement if you do decide to go through that institute based on your production with us. So we put our money where our mouth is as far as this concept goes. And as you'll learn more as we go along here, it's really a big part of what mutual trust is all about. So what is the infinite banking concept? It really is a concept that, simply put, is about having a new source of capital, another source of capital that you can access efficiently and you can maintain control of. That's really, in a simple nutshell, what it's about, a pool of capital. But that doesn't do it justice. There's a many more advantages that go into this, as we'll see. So access to capital is the key to financial prosperity, and that's true for individuals and for business owners. You need access to capital to make purchases, whether we take those funds out as a loan from a financial institution, or we save up a pool of money and draw on it when we need to. So where are our clients keeping this money? Is it liquid? Are they able to get to it when they need it? Is it guaranteed? Will it be there when they need it? Is it taxable? And this is an important part, because as that account grows, if it's taxable, the taxes that they are paying on that pool of capital are also increasing and eating away at our wealth. And we'll talk more about that. Can it be leveraged? Or is it leveraged? Does it provide additional benefits besides just a pool of capital sitting there? Will it still grow if they use it? In other words, can it be collateralized? And we'll talk more about the importance of being able to collateralize. These are all things that you want to see when you are establishing the infinite banking concept. These are important aspects of or features that we want to see in these types of accounts, in this pool of capital. So many times they're keeping this money in places like CDs, where they're earning 0.05% on a savings account, and then getting taxed on top of that. It's like adding insult to injury. They're getting kicked in the teeth on the way up. CDs are getting you about 1.5 maybe. Rates are starting to normalize, so hopefully those rates will continue to go up. Money market accounts, same thing, maybe about 1%. Spending efficiencies, that's just saving more money. I mean, where our clients are already tapped out as far as savings goes, so that's not why they're coming to us to hear that to hear us say that, hey, you just need to save more money. So that's not the area that we're going to be looking at to help them build this pool of capital. Cash, if they keep it in cash, there's many limitations to that. You're going backwards with inflation if you're just keeping your money in cash. Actually, with all these accounts right now, you're going backwards. If you even if you look at the published rates by the federal government, which if you go back and look at the history of the basket of goods that they look at for inflation, it's changed quite a bit. And many people believe that the inflation rates that are published today are understated. But even if you go by their roughly 2% number going throughout history, if you're sitting in if this money's sitting in an account right now or sitting in cash, your wealth is being eroded. So what is a better option than these other accounts? Well, obviously we believe it's participating whole life insurance. And the reason is it provides the guarantees, the certainty. There's only one product out there that provides a guaranteed premium that can never change, guaranteed cash value growth that can never go down, and a guaranteed death benefit that can never go down. And we also maintain a huge amount of liquidity, use, and control of your money. And that's really where the importance of the carrier comes into the infinite banking concept. You can build a product that has high cash value. And ours, by the way, has guaranteed cash values that are head and shoulders above everybody else out there. That's where we've buttered our bread for a very long time. And the name of the product that we use for that is called the Horizon Value. You can build a product like that, but if you don't let clients use it, then what good is it? So many times we've had other agents who have tried to implement the infinite banking concept, and they'll try to do it with other carriers. And those other carriers will say, yeah, we'll take that business. Let's take the application is what they're really saying, because once those loan requests start coming in, and loans are a big part of this, as you'll see, once those loan requests start coming in, they start pushing back. And so we are built to do this. You have to be not only have the right product to do this, but you have to have the right carrier and have that product be able to be used in the way that it needs to be in order to build your infinite banking business. Okay, so you can take money out tax-free with no penalties. So we have the product, we have the training across the company, and we have the support to help you implement the infinite banking concept. And we'll talk more about that in a little while, but it's difficult to, it's simpler to have a client understand that they have a problem and then provide the solution. If we just share a solution with them, they may not understand the power that the help that it can provide to them, unless they understand that they do indeed have a problem. So for many business owners, they have a need for capital. It's very key. It's a critical thing for businesses to have access to capital to help grow their business or meet unexpected needs. Same with individuals who are just trying to cope with maybe some of life's emergencies, or maybe they want to buy a new car every 5 years. They like the smell of fresh leather every 5 years. It also helps them keep more of what they make. It's really, there are a lot more opportunities to recapture or recoup money that people are spending away from themselves than it is to try and eke out another 1 or 2 or 3 percentage points of return. There's a lot of opportunity there to recoup lost interest and lost taxes, as we'll see. It also helps to deal with the limits on qualified plans. Qualified plans are great vehicles. Again, the infinite banking concept helps what they're already doing work better, but there are limits to qualified plans as far as being able to collateralize them, use them for other things other than retirement. And with a traditional IRA or a traditional 401k, what are we really doing there? Well, we're putting money in and we're delaying the taxes, but we're also delaying the tax calculation. And the only way we really win in a big way on these qualified plans is if we're taking that money out at a lower tax rate than when we put the money in. That's really where we're winning on those plans. So the government's along for the ride on those. You have a government as your partner there. And there are many studies that show that taxes, in fact, have not been lower than in retirement than when you were in your working years. So, I mean, if many people are thinking they're going to have a lower standard of living, first of all, why would you want to have a lower standard of living in retirement? But anyway, they're thinking they're going to downsize and sell the house, and they're going to have, less income, and they're going to have lower taxes. Well, people aren't doing that. They aren't downsizing. The taxes have been increasing, and then they have other things that are increasing at that time, like health coverage and things like that. So the idea that taxes will be lower in retirement is also challenged by the fact that we have a historically low income tax rate, below average. We have $20 trillion in debt, $200 trillion in unfunded liabilities, and a government that seems unable to cut its spending or implement any kind of fiscal discipline. So the idea that taxes are going to go down, there's a good argument to say that they actually will be going up. So how do we take some of that out of the equation, remove some of that risk out of the equation? Many of our clients' plans are just built on risk. Let's get some guarantees in there. Let's take some control of some of these things we can't control, like taxes, like inflation. Okay? And how do we help them take ownership of their debt and help them to recoup some of that interest that they're spending and put it into their own pocket and accumulate for their benefit? So what is the biggest financial problem that is facing the average American family? Well, many will say it's saving for retirement. And doing that, if they have a family, trying to do that and pay for college as well, or help their kids get through college. It's a huge challenge, especially in this low interest rate environment, to do it safely. And their wealth is being eaten away at the same time, and they don't even realize it in many cases. You have, according to this chart, you have about a little over a third of every dollar being spent going to interest for their auto purchases, for their living expenses, buying a new car, what have you. What this chart doesn't show that is about a third of their money is going to taxes as well. When you include not only income taxes, but real estate taxes, state taxes, you add all that up, and about a third of the income is going to taxes. So that, you add in living expenses, and then that leaves about 5% that they're able to actually save. And the rule of thumb is you need to save 20% to retire and have a pool of capital that will last you through retirement. So they're not, when they come to us, we're not going to be talking to them about saving more money, because in their minds they're already tapped out. But what we can do is help them find money and redirect it into their own pockets. When we talk about loans, we talk about interest rates, and interest rate is important, but it's also the volume of interest that we need to look at. If you look at a car loan, for example, if you have a 7% car loan, which sounds high now, but in the future, as interest rates continue to normalize, all these rates are going to be going back up. Right now, if you have a car loan and you have a $30,000 loan, you're going to have about $175, 30% of that loan going to interest. That's just paid away and lost you forever. Credit card payments, we have some clients out there that are sitting with savings accounts with a 5% or a 0.05% interest rate, and then they're paying 12% on their credit cards. Maybe there's something we can do with that money to help them pay down this credit card debt and recoup some of that interest. About 40% of every dollar that they're paying is going into pay interest on that credit card debt. A 6% mortgage, about 83% of that is going to be going to interest. And I know many clients think, well, I'm going to pay down, and by the time I get 25 years out, most of that will be going to principal. Well, what has everyone been doing over the last 15, 20 years? Well, they've been refinancing their debt, restarting that debt clock or the amortization schedule, and they're just continuing to pay more interest. Is there another way that we can do this that's more efficient and builds their own wealth? All this adds up to $306,000 in interest over 20 years for a typical family. And it's not just the $306,000 that they're losing. They're losing the interest that they could have earned on top of that interest that they're losing. And that's really where the wealth building can be accelerated, by taking advantage of that money and investing it and letting it accumulate. So when we finance our purchases, when we make major purchases, we are actually financing typically in two different ways. We're either paying loan interest to a car company or a bank or some financial institution. We take out a loan, they check our credit, it goes on our credit report, they set us up on a payment schedule, they dictate the interest rate based on our income and our position financially. And then we start making payments on a loan. The other way is that many clients will withdraw money out of a savings account. They'll set up these put and take accounts where they put money in, they build up cash, they earn some interest on it, and then they take it out. And that's a form of financing, because all things being equal, if you had an account earning 5%, let's say we're in a normal interest rate environment and they're earning 5% on their account, right? And versus taking out a loan at 5%, if we assume they're going to pay back that loan over 5 years, in both cases, either paying it back into their savings account or paying off the loan. If it's the same amount of money paid over the same number of years with the same interest rate, the cost, when you look at it, is exactly the same. In one case, you're going below the zero line, going into debt, and just making payments to get back to zero. In the other one, you're draining the account down to the zero line and putting money back in to try and get back to where you were. Albert Einstein once said, the compounding is the eighth wonder of the world. So if that's true, how often do you want to interrupt that compounding? The answer is never. And preferably, you want it to be able to grow with as little impediment as possible, meaning you want to do it in a tax-free environment. Okay, that's a big part of what the infinite banking concept is about. You set up a policy, and it has to be a properly structured policy, meaning that it's maximum funded, but below the MEC line. And we can talk in more detail about numbers in the next call. Right now, I'm just trying to lay the foundation, give you the concept. But what we want to do is we want to maximum fund a whole life insurance contract up to that MEC limit, which that maintains our favored tax treatment. Okay, this provides guaranteed cash value. You have the flexibility to take it out when you need it. You have flexibility to pay premiums in varying amounts at varying times, as we'll see. These policies aren't the old whole life policies where you just had one premium payment and you had to make that payment and it was the same every time. We have things called paid up additions riders that allow us to build an extreme amount of flexibility and variability into these plans. You have uninterrupted compounding through collateralization. So when you implement the infinite banking concept, what you are doing is you are building a pool of capital. You are accessing it at rates that are generally going to be lower than other financial institutions in normal interest rates environments and even now. That's not to say that you use your pool of capital in your whole life policy for every single purchase, but it puts the client in a position where they can negotiate the best rates and have access to capital that is guaranteed, that doesn't show up on a credit report, that they can pay back on their schedule. Of course, they want to pay it back as soon as they can, but they can pay it back on their schedule. And nobody's going to come looking for them if they decide they need to miss a payment here or there. Okay, and it's guaranteed to be there. They have access to it from day one. You send in the premium goes in. Some of that's going to go into cash value. Whatever's there can be loaned against up to 95% of the cash value. Plus, they get an immediate income tax-free benefit. And what that income tax-free benefit does for them, that death benefit, is if they care about their family, as I do, as long as I'm alive, I'm going to make sure that my family's well taken care of while I'm here and afterward. And what it does is it allows them the ability to later on in life spend down other assets they're accumulating. Some of those risky assets, their 401k, their real estate if they have any, take a reverse mortgage on the house. When you have your legacy guaranteed and sewn up, it allows you to use those other retirement assets to a greater degree and actually increase your standard of living in retirement while still being able to provide a legacy to your kids and your grandkids. So again, it helps everything else work better and provides guarantees in their financial plan. Right now, if you don't have guarantees in a financial plan, well, as many don't, they're doing the old buy term and invest the difference. And that's a risk-based plan because everything has to go right. But what if things don't go right? What if taxes are higher than we expect? What if we get sick before we retire? What if inflation goes higher than we anticipate? All of these things can derail a financial plan if they happen at the right time or the wrong time. So let's put some guarantees into this plan, help them build their wealth and grow it and recoup some of that money that they are transferring to these other financial institutions and to the governments, because taxes and lost interest are a huge erosion factor in their financial plan. And we can recoup some of that, not all of it, but some of it. And we can redirect it. And it's not just those interest dollars. Again, it's the compounding on those dollars. An important aspect, and we'll look at this more closely in the next call, but an important aspect of infinite banking is to act as an honest banker. So if I am in a position where I have my pool of capital built up and our current loan interest rate is 5%, okay, I have this pool of capital sitting here at 5%. Versus if I had never built that pool of capital up, what would be my next best alternative? Well, if you're a small business owner, maybe you'd go for a small business loan, and you're going to pay about 6.25% to 8%, depending on the amount of the loan and the length of time you want to take the loan out for. Okay. If you act as the honest banker, you're going to build your wealth even more quickly, because what you can do is you can access your pool of capital, your bank, at 5%. And then pay it back. Now, you don't pay it back at the wholesale rate of 5%. You act as a grocery store owner or a business owner, and you're the owner of this bank, and you pay yourself back at the retail rate. You're recouping 6.25% to 8%, and that's not just 1 percentage point to 3 percentage points. That's 30 to 50% of your interest over your lifetime that you're recouping, plus compounding it when you redirect it back into your banking plan, into your infinite banking concept policy. That money is going to then accumulate and start working for you instead of being transferred away from these financial institutions. Banks are taking money in at, let's say, 1% and loaning it out at 5 or 6%. They love these low interest rates environments. That's a 500% markup on your money. It's not just 5 percentage points they're making, it's 500% that they are making on your money. And they're taking $1 in and lending out 10. All right, it's a great racket for them. We can do that, not in that way because we have to use our own money, but we can do some of that and recoup that money that they're building their wealth and recoup it into our own pocket and build our wealth and our clients' wealth. And there's a lot of misconceptions about the infinite banking concept and how to use it, but you don't need to finance every single thing with your banking policy. It's just a way to empower the client to, again, get them the best rates possible, recoup some of the taxes that they will be spending. If this money was in a taxable account, they'd be spending away that money in interest taxes, get their 1099 every year, and so on. So we're recouping taxes, we're recouping interest, and we are building their wealth. So who are the clients that we're looking for? This concept has a broad appeal. Business owners love it. They especially love our high cash value accumulation with the guarantees in the early years so they can use it right away. And we can build policies that can be paid up in as little as 2 payments. This isn't a situation where you have to start paying and pay forever. There's a lot of, as I mentioned before, a lot of variability built into these policies and how we let you use them. Doctors, dentists, other professionals, clients who want to avoid red tape and they want to take a loan from the bank every time, or have they're worried about maybe the real estate taking another dive and they've got a line of credit out, and maybe that line of credit will be called. Maybe they're going to lose that. Maybe they don't have access to that capital for whatever reason. Maybe their credit's not so good. Clients who want liquidity, use, and control of their money. This is a big, those 3 words are very big with mutual trust. And that is something that we really emphasize are those living benefits. Clients who are looking for safe asset alternatives. Whole life insurance, when you look at everything that it does, it isn't looked at as an expense. It's an asset. It's a financial asset that provides benefits that no other financial asset provides. And we've already hit on those, so I won't hit on it again. But as far as thinking of it as an expense, it's not so much as an expense as it is an asset that truly diversifies everything else you're doing and underpins everything else that the client is doing. And they do need to be insurable since this is life insurance. And these families will have a desire to protect that family. We're not talking to the individual who says, well, I'm going to just spend all my money and I don't want my wife to be too rich or my kids to be too well off or anything like that. They want to just be able to get through their life and their family's going to take care of themselves. There aren't too many people like that out there, but that's not who we're looking for. We're looking for those individuals who want to make sure that their family is going to be taken care of, whether they're here or not. Again, whole life provides guaranteed premium, guaranteed cash value growth. The paid up additions rider provides the flexibility while still maintaining those guarantees. We have the most flexible paid up additions rider in the industry. You can fund it at anywhere from $100 minimum up to $100,000 maximum every single year, all the way up to age 90. And you don't have to fund it at certain levels every year to maintain access to it. You're underwritten only one time up front, and that's it. No future underwriting required. And it doesn't matter the size of the base policy that you have, as far as the size of the premium you could put in, with the exception of you want to make sure that you don't fund it beyond that MEC limit, because these are cash-rich riders. So you put $100 in, you're going to see about $96 show up in the cash value right away, and then that starts compounding at 4% guaranteed every year, plus dividends. Okay, and you want to make sure that you can take those policy loans, and we are built to do high frequency loans. It's about 40% of our business right now is infinite banking, and we are built to take those high frequency loans, and that is something that most carriers are unable to accommodate. We also have something called a waiver of premium. And if you're only familiar with maybe IUL or UL, this is called a waiver of cost. What the waiver of cost does is in an IUL, it just prevents the cost from being taken out, but it doesn't add any cash into the policy. With a waiver of premium, we actually pay your premium so that you are actually building cash value when you're on the waiver. The waiver can be accessed if you're unable to do your own occupation for either 2 or 5 years. That's the standard for 2 or 5 years, not being able to do your own occupation, and we will pay for the premium for you. After that, we go to a comparable occupation. If you're unable to do a comparable occupation after 2 or 5 years, then we still pay the premium. We have the same or similar waiver on the paid up additions rider called the disability benefit rider. And this is really rare. I think there's only one other carrier that does this. We'll cover up to $15,000 a year going into your paid up additions rider where a lot of that cash accumulation is occurring. And so we'll actually put up to $15,000, whether you're funding it at that max level or not. If you qualified for it and you were paying 100, but you qualified for 15 and you go on the waiver, we're going to fund at 15. We're going to fund at the max. So it's a powerful rider, and you can actually think of it as a supplemental retirement insurance on your insurance. So it's a way to help make sure that your financial plan is not derailed if you become disabled and unable to work. So again, buffering what you're already doing, putting some guarantees into your plan. We also issue a terminal and chronic illness rider. Terminal illness is accelerator is pretty typical in the industry. You can get up to $250,000 of acceleration or 50% of the face amount, whichever is less. The chronic illness rider allows you to accelerate all of the death benefit. There is no cost to that rider. You can accelerate up to 24% per year, anywhere from 5 to 24%, if you are unable to do of the activities of daily living. So maybe if you have clients that are not willing to purchase or unable to purchase long-term care, this might be a way to help offset the cost if they become disabled or need in-home care or nursing care. Okay, and we can talk more about that later on. And hopefully you'll contract through IMS, get to know Mutual Trust and everything that we're doing, including the infinite banking concept. And we are dedicated to this concept. We train across the company for it. We have a module in our software that helps illustrate these loans and repayments and show the benefit of doing that. Robust training with trainings like this, and with online on-demand trainings through our MTL University. And we have marketing materials to help present this concept to your clients. So at the beginning of this call, I wanted to make sure that you understood the concept and that you have clients for whom the concept will work. And now I just want you to think about those clients in your book of business or on your calendar. Hopefully you've written a name down, and give this a try. Try it one time. If it doesn't work out for you, then I respect you for trying something new. But if it does, this could be a substantial increase to a substantial new source of revenue for your practice. Typical IBC street commission, I believe, is about $8,000. So you just do a few of these cases, and many are much higher. You just do a few of these cases, and they can really make a big difference, move the needle very quickly on just a few cases. It could be an additional $80,000 to $100,000 if you just do one a month, an additional revenue to your practice. Now, I'm almost done here, Mark, but I just wanted to mention that if you sign up through IMS, in the first 4 months, we have a special where we will double your credit in earning credit towards our conference. And we're going to Australia next year. And our requirements, even without doubling your credit, are very reasonable. It's $30,000 for a writing agent to qualify for our Vanguard conference in Australia. And we calculate that $30,000 of credit as 52.5% times base premium. So that would be typically a little less than $60,000 in base premium would get you to Australia. However, we're doubling that in the first 4 months. So if you manage to do $30,000 in base premium in the first 4 months, that would get you to Australia. And I know that sounds like a big number, but when you're working with whole life and these concepts, that can add up pretty quickly. And you can look at this as a double bonus. So I know IMS has their bonus program and their rewards, and you can actually get double bonus because you'll also be earning your chance to go to our Vanguard conference next year. And you can do it, again, with as little as $30,000 in premium. Plus, if you watch 6 videos on demand on our website, they're each 40 minutes long. You can watch them anytime. We'll give you another $2,500 in credit. So now you're talking about 26 and change, all to go to Australia next year. So it's a fantastic opportunity to go to a bucket list destination, and I hope you can take advantage of it. You also, at the same time, will earn expense reimbursements up to $1,500 based on production with us. So again, we're really encouraging that education and implementing one of these selling systems, including the infinite banking concept, which is a big part, again, of what we do. And I've seen this implemented very successfully time and time again. And the people who are using the infinite banking concept really love what they're doing, because they're really able to make a difference for their clients and do something that they have never heard of, and it's something that nobody else is talking about out there. So I encourage you to take a look at it. And Mark, I'm happy to take any questions or comments.
Perfect. Okay, so the question box is open, and in that process, I'm going to put up, just real quick, if you're interested in getting in contact with Mutual Trust, I'm going to go ahead and put this out there. If you just mark yes, I'll email you the contracting. Pretty simple. In addition to that, as Kip was saying, you look at the qualifications. So anything that you write with Mutual Trust, you're not only getting credit for their trip, but you're also getting credit for ours as well. So, okay. So, well, we don't have an illustration to show here today, Steve, but on the next one that we're going to host 2 weeks from today, Kip will have an illustration to show how that performs. Correct, Kip?
Correct. We'll get into the numbers on the next call.
Yep. Okay, so I want to be sure that...
And we'll show you how it works, how we set it up, how we build it. So, yeah, definitely want to stay tuned for that.
Okay. Farrah's got a good question. Farrah says, what is the advantage of using whole life compared to index universal life?
The advantage is the guarantees. IUL does provide an opportunity to capture higher rates of return by tying its movements to index in the market. But much of what we are doing in current financial plans are based on equities and the movements in the market. We need to introduce some guarantees that make sure that the cash is going to accumulate no matter what else is going on, whether it's in the equities or in bonds. Even bonds right now, interest rates are starting to go up, so bonds are going to go down. There's an inverse relationship with interest rates to bond prices. So what whole life companies do is they take all of that risk. They take all of that risk, the risk of you dying too soon and the risk of the markets not providing the rate of return that you want to see. And we're uniquely able to do that by spreading risk over different generations. Only whole life companies and life insurance companies in general do this, but whole life companies take on all of the risk. And so when you have to think about the pool of capital that we're building, you think about where these clients are keeping it. As I mentioned, many times it's in savings accounts, so it's readily accessible, because they want to make sure that it's not going to go, it's not going to be lost, and so or be inaccessible. And only whole life provides that level of guarantee for the cash values. It's not to say that you can't use IUL, but it's when you talk to Nelson Nash and other practitioners, they will only use whole life, again, because of the fact that cash value has to go up every single year, year in and year out. It can never go down, and it'll never stay flat.
All right. Any other questions? Go ahead and type those in there. And just a reminder, too, I'll be emailing this recording over to you of today's presentation, and then the contract as well for those of you that are interested. And then, of course, if you have any questions, if you have any cases you want to discuss, you can certainly give us a call here at the 800-255-5055 number. Okay, here we go. All right, so Farragon asks, what happens to the interest crediting during a policy loan?
So that's a great question. During a policy loan, the interest continues to accumulate. We have a guaranteed 4%, and that's paid no matter what. And that's where the power of that collateralization comes in. Instead of withdrawing money out of the policy, we're leaving the money in the policy. You can think of it as if you had a pool of capital sitting in a savings account, and instead of withdrawing the money out of the savings account, you pledge that money as collateral to a bank. All right, that's another way to implement the infinite banking concept, but it's very inefficient. It's still getting taxed. You still are taking out loans that are showing up on your credit report, and the bank still has a lot of power over what you're doing. With the infinite banking concept, same thing. Money's accumulating, but it's accumulating tax-free, and we're able to get that loan no matter what, and it doesn't show up on a credit report. They're just the financial, the carrier, mutual trust, is a financial institution with different contractual agreements in place. It's more personal. It's contract for business to client. It's not a lot of these financial regulations that are built around banks don't apply to us. So what we're doing is we are taking a loan, putting a lien against your money in the life insurance policy, and once that money is paid off, and as the money is paid off, the lien is released. But the money continues to grow, so that once you pay off that loan, you never interrupted that compounding, and you were in the same position you would have been in had you never taken the loan.
So Donald asks, obviously I think short and sweet, this is part of how come this is so successful, but Donald is asking if MTL is a dividend-paying company.
Yes, absolutely. We're a participating whole life company, and we have been in existence since 1906. We have paid dividends every single year since 1909 without fail. We merged in 2015 with Pan American, which is another participating participating company, mutual company, and we are now altogether part of a solidly mid-sized A-rated carrier by Standard & Poor's and Fitch. And we have $5.5 billion in assets, $1 billion in capital and surplus, and are very well funded to continue to grow at the 17% rate that Pan American has been enjoying for the last 10 years. So, I mean, we are really a company that has a lot of great things going on. But yeah, that's a great point. Participating whole life insurance is an important part of the infinite banking concept and success of that whole program.
Okay, so Richard is asking, can the waiver of premium or the DBR be added to an in-force policy that was written without either rider?
No, they would have to get underwritten again to do that. So unfortunately, we can't add it.
Okay, and Douglas asks, what is the interest rate, and is it variable or guaranteed?
The interest rate is guaranteed, and it's 4%. And then if we do better than that in our investments, which is where most of the dividend comes from, we share that with our policyholders. That's how, after all, a participating mutual company rewards its shareholders, and its shareholders are the policyholders. There's no conflict there. So if we do better, we reward them through dividends. In 2015, we were the only company to announce an increase in its dividend scale for 2016. And moving forward, we just feel like in an interest rate environment that we're in now, where instead of for 30 years, we've had falling interest rates. Okay, and now we're in a rising interest rate environment. So as long as that continues, we feel really good about the dividends and rate of return that we're going to be receiving. And we have an investment division that is getting 100 basis points above the average in the industry. They're in the top, I think they're in the top 1% as far as investment return for asset management. So, I mean, when you talk 1 percentage point, 100 basis points in life insurance, that's huge. And so we are very well poised to continue paying very strong dividends going forward.
Super. Okay, Kip, looks like the question box is empty. So, Kip, thanks for taking time to help us out here this morning. And everyone out there, thanks for taking time here. Again, Mark Raymakers here. You can expect a call back from here earlier, probably in the next couple days here. See if you have any questions. Any case we can help with, I'll send you out an email as well with the recording and the contract. And again, our number here, if you have any questions, is 800-255-5055. Have yourself a great week, and look forward to speaking with you soon. Thank you again.
Thanks, everybody.